What if everything we thought we knew about debt, inflation, and the US dollar is backwards? It started as one man speaking at a conference, but what he revealed could trigger the most significant global wealth transfer of the 21st century. An explosive claim has sent ripples through economic circles. The United States is allegedly planning to erase its $37 trillion national debt by moving it into the cloud. Not just any cloud, but a crypto-fueled stablecoin-backed cloud. The implication: the dollar system can reset itself not by default, but by exporting the cost to every nation and citizen holding US dollars. And here's where it gets even more intriguing. This idea wasn't just mentioned by a Russian official. A major American billionaire, Michael Saylor, CEO of MicroStrategy, has floated a similar vision. So here's our question to you. Do you think America could digitize away its debt? Yes or no? Let us know in the comments. Because by the end of this video, we'll uncover the link between crypto, gold, and the US debt, and why countries around the world may be rejecting digital dollars, but hoarding gold at historic levels. This is epochreport, where we break down the signals behind the noise. During the recent Eastern Economic Forum in Vladivostok, one of President Putin's top economic advisors, Anton Kobyakov, went on record with a bold allegation. He claims that the US government is plotting a financial reset of epic proportions. According to him, Washington plans to digitize trillions in debt, loading it into a crypto cloud infrastructure, and then let inflation and stablecoins slowly erase it. Let's pause on what that means. The idea is to restructure $37 trillion in US government debt, not through repayment, but through a shift in platforms from traditional bonds to blockchain-enabled financial instruments. This would create a new mechanism. Instead of directly inflating away the debt, US Treasury bonds would be embedded into assets like stablecoins, making anyone holding them an indirect participant in the value erosion. And that erosion would spread the cost across every wallet and reserve on Earth holding dollars or dollar-based reserves. It sounds insane. That's what we thought until we realized that someone on the American side was pitching something very similar. Enter Michael Saylor, the billionaire founder of MicroStrategy, and one of the most aggressive corporate buyers of Bitcoin in the world. He's already accumulated hundreds of thousands of Bitcoin in corporate reserves. He's proposed a radical plan. The US should sell off its gold and pivot to Bitcoin as its new sovereign asset. According to Saylor, Bitcoin's value could rise into the tens or even hundreds of trillions of dollars, allowing the US to essentially restructure its balance sheet with digital reserves. His suggestion borders on the fantastical that Bitcoin could become the foundational collateral for a reimagined global financial ecosystem. One where the US not only survives its debt burden, but uses crypto to continue leading the monetary order. But could something like this actually work? Our analysis: not only is it feasible, it's already happening, just not always in the ways people expect. To understand this strategy, you don't have to look to the future. Look to the past. Debt devaluation through inflation is not a conspiracy. It's policy. Picture this. There's only $10,000 circulating in the entire global economy, representing all goods and services. Option 1. I work hard and repay the full amount in real value. No change to prices, no magic. Option 2. I print another $10,000 out of thin air and repay you with that. Now there's $20,000 in circulation, but the amount of goods hasn't changed. Prices double. You got your money back, but it buys half as much. That's how inflation silently erodes debt. Real financial extraction, but entirely legal. And the US has done this multiple times. First case? Post-World War II, in 1946, US government debt reached 106% of GDP, dangerous levels, rather than aggressively cutting spending or raising taxes. The government and the Federal Reserve collaborated by keeping interest rates low and letting inflation run hot. Prices rose over 35% between 1946 and 1951. The result? A shrinking debt-to-GDP ratio, which fell below 40% by the early 60s without paying down a dime in real terms. Second case, the 1970s. The Nixon shock of 1971 untethered the dollar from gold, triggering waves of inflation. Oil crises followed. Mortgage rates passed 10%, but the real value of government debt eroded, offloaded through invisible inflation taxes. Third case, the COVID era. Between 2020 and 2023, Over $5 trillion was created in stimulus, QE, and emergency programs. Debt surged from $23 trillion to nearly $33 trillion, but so did inflation. Everyone paid for it at the gas station, in rent, in food, while the debt problem quietly shrank in relative terms. If that formula worked before, why reinvent it? Because this time, they want to globalize it. Here's the catch. Traditional inflation hits domestic populations fast and hard. Prices spike, interest rates rise, political blowback intensifies. But stablecoins offer a clever workaround. These are digital tokens pegged to the US dollar, but often backed by short-term treasuries. Every time someone uses a stablecoin, they're indirectly helping the US Treasury because issuers like Circle or Tether hold actual US debt as reserves. That creates a loop. Use tokens gives by treasuries, gives issue more tokens, gives more global liquidity in dollars. And if inflation hits the underlying dollar, every holder of those tokens shares in the loss of purchasing power. Global users pay the inflation tax, not just US citizens. It's a financial export of inflation. And best of all for Washington, it appears apolitical. Unlike central bank digital currencies CBDCs, which come with massive privacy concerns and political baggage, stablecoins are often issued by private companies like tech giants or regulated banks. By outsourcing the issuance to firms like Meta, Apple, or fintech startups, the dollar extends its reach under a less threatening guise, as long as regulators approve it and firms stay in compliance. The US gets the benefits of a global digital dollar without the centralized optics of a government-controlled token. This layer of corporate, plausible deniability makes stablecoins harder for foreign governments to resist, but still keeps them wired into US debt markets. Or at least, that's the plan. If you're still with us, you're not here for surface-level takes. Make sure you're subscribed to epochreport and turn on those notifications. We dive deep into the economic shifts mainstream media ignores, and in just 10 minutes a day, we help you see the real patterns before markets move. Are so few nations embracing stablecoins? The answer is trust. Stablecoin firms may claim their tokens are backed one-to-one with real assets, but auditing is untransparent to sovereign governments. Tether and Circle might be honest today, but there's no enforcement mechanism tomorrow. And let's not forget 1971, when Nixon unilaterally ended the dollar-gold link. It shattered a global promise, and the Bretton Woods system with it. It's a lesson foreign governments haven't forgotten. So instead of embracing tokenized US debt, many nations are hoarding physical gold, a hedge that has proven resilient over millennia. Back to Michael Saylor's plan: sell off US gold reserves, tank the gold price, hurt rivals like Russia and China who rely on gold, then massively accumulate Bitcoin. Push Bitcoin so high in value that it becomes a new form of global collateral, allowing the US to reset its financial system under a new standard it controls from the top down. While the US government appears to have rejected directly buying Bitcoin for now, it may be allowing private firms like MicroStrategy to carry out this strategy quietly. These companies can acquire massive stacks of Bitcoin with little scrutiny. If Bitcoin gains reserve status, the US could later step in, purchase stock in these firms or regulate their assets, effectively nationalizing their reserves without ever making direct crypto purchases. It's financial chess, not economic checkers. Here's the truth. However it plays out, via stablecoins, Bitcoin, classic inflation, the $37 trillion must go somewhere, and that means someone will pay. Asset holders, stocks, property, gold, they'll likely be insulated, or even benefit. Inflation raises prices, assets rise with it. But wage earners, people living paycheck to paycheck, will see their purchasing power eroded. Dollar income doesn't adjust as fast as prices. It's a stealth tax, imposed by debt restructures few voters understand. And because it's hidden in mechanisms like crypto, stablecoins, and inflation metrics, the pain will hit before most people even realize what's happening. We can't control central banks, but we can control how we prepare. That starts with protecting ourselves from declining currency value. Stocks and index funds can outpace inflation. Real estate tends to rise with consumer prices. Gold continues to be a safe harbor when fiat trust collapses. And yes, even Bitcoin, despite its volatility, functions effectively as an asymmetric hedge. But most important, execution. What you decide to sell and when matters as much as what you buy. Positioning yourself now is key. This shift isn't years away. It's already unfolding. So here's our question to you. Is this coming digital debt reset a ticking time bomb, or is the fear overblown? Leave your thoughts below. We read every comment. If this video gave you a new perspective, don't just click like, subscribe to epochreport, and hit the bell. In just 10 minutes a day, we help you spot the patterns shaping our world before most people even hear about them. Timing matters, especially now. Stick with us. We'll see you in the next report.